we will be putting this up on our website and sharing it out as a resource to the community later. We'll take questions and answers in the chat box. I'll be going ahead and moderating those. So if you have a question, please go ahead and type it into the chat box as we go along. And then again, at the end, we'll go through those. Our presentation will be about 30 to 40 minutes and giving you an update on what's changed with the PPP program. We're excited today to have two distinguished CPAs to walk us through from Polito and Epic, an SDNEDC investor, Jessica Dorsett, who is a partner with Polito and Epic and heads up their tax program practice, excuse me, their tax practice, will be taking the lead in walking us through those changes, and she will be joined by Paul Polito, another partner with Polito and Epic, who will provide additional guidance. We did this about a month ago, and one of the things that we heard, which we think can be particularly beneficial, is to get a banker's perspective. And so we've been joined by SDNEDC's treasurer, Chris Wiseman, from Home Street Bank. Chris has been a business banker for several years. I won't date him or myself because we both have, you know, a little bit of gray hair. But Chris is going to give you the perspective from the banking community because they will be your interface at the end of the period of time as you go through to do a true up and look to convert the money into a forgivable grant. So with that as introduction, I'm going to go ahead and switch it over to Jessica, who is going to go ahead and now will be host, and then she will be able to share her screen and walk us through. Again, if you want to go ahead and mute your line as you see fit, and then that way we'll avoid the crosstalk. And with Jessica, take it away.
Okay. Now I have to admit people too. Okay, I think I got that.
We should be fine. Sorry about that.
That's all right. All right. Hi, everyone. Thank you so much for having us, Eric. We are very happy to be a part of this and to help. Okay, sorry. Don't
worry, Jessica. If people are late, if people are late, they're late. So you can let them in as need be.
All right. We'll go ahead and get started. So a lot has changed since we have been with you all for the last month, I guess, or a little bit more than that ago. Our world just doesn't seem to stop with this program. So the most recent change was the Flexibility Act that was passed on June 5th, or signed into law June 5th. So the biggest changes that came through on that. We went from the original act that provided for an 8-week covered period, now is a 24-week covered period. And any new loans that are generated after that June 5th date will automatically be 24 weeks. But if you have your loan from before that, you may elect to use the original 8-week covered period. Regardless, the covered period will still start on the day your loan is funded. But if you want to make the election to the 8-week, you have that ability to do that. So we'll definitely be doing a lot of consulting with our clients around that as far as what's the best approach. You know, I think more than not, we'll probably go ahead and use the full 24 weeks, but the 8-week period there may be a reason for it for some clients. The other big thing was the 75% payroll test. So before, it was you had to use at least 75% of your funds on payroll expenses, and now that's been brought down to a 60% test, and that is not a cliff test. So it's not an all or nothing. It is still a sliding scale based on the percentage you use. So if you use 59%, then there's going to be a calculation that reduces your overall forgiveness by a little bit. There are some new FTE reduction exceptions that were added. So if you are unable to rehire individuals who were employed as of February 15th, and you couldn't hire similarly qualified employees for unfulfilled positions by the end of the year, then that will qualify for an exception on the FTE test. There's also an exception for if you are impacted by certain guidelines or restrictions on business that have been imposed by very specific federal agencies that are listed. And I can share that with you. If you're not able to, a good example would be restaurants or retail, where they can only allow so many people into their place of business because of social distancing requirements and spacing and things like that. But it is specific to federal agencies. So we've got to be careful to not get that confused with state requirements. And so the three agencies that were listed were the Secretary of Health and Human Services, the Director of Center for Disease Control and Prevention, or the Occupational Safety and Health Administration. So you're going to want to look at that as it relates to your industry and your business. And a lot of that may flow through to the state level or county level, but it needs to be something that started at the federal level. And so be careful about that. And again, document, and you're going to hear this from us throughout. Documentation is still very critical with all of this. So if your business operations are reduced and therefore your FTEs are reduced because of those, that is an exception to the FTE test. Any new loans will have a repayment of 5 years instead of 2. Any existing loans that were funded before the June 5th date, if there's mutual consent between you and your bank, then you could extend that to 5 years. And again, that's only on any amounts that's not forgiven. And I think most small businesses are pretty well set up at this point to get 100% forgiven with these new guidelines, but there certainly will be some exceptions. And then this was a big one too. So this last point here, before under the rules, if you receive the PPP loan, you could not defer your federal tax, employment taxes, payroll taxes, and now you can. So this is one of the other benefits that came through the CARES Act, I think the CARES Act, where if you can defer your federal payroll taxes until next year. So basically you wouldn't pay through the end of the year. 50% of that would need to be paid by December 2021, and then the remaining 50% would be paid by the end of 22. And so if that's something you need to take advantage of for cash flow purposes, I would certainly talk to your CPA about that and your banker about it and your payroll provider about it if you're doing it through a payroll. It would be helpful, but you will want to keep very good track of that because you will have to pay it. So it's going to show up as a liability, and you'll want to manage your cash flow accordingly.
Just a couple of comments, Jessica, on this. Some guidance just came out last night. I was just going through that today. And as far as the documentation that's going to be required to prove that you were not able to operate at the same level that you were able to prior to February 15th. What they state in there is that many agencies, state agencies and local governments based their provisions on those federal agency guidelines. And the language seems to be very borrower friendly in as much as it says, if this is if it's based on that and you are subject to it, you're going to be okay. So that's one thing. Another thing I'd like to point out is the payroll tax deferral is basically a loan that you're getting, and payroll taxes are not forgivable. You can't bankrupt out of them. You're personally liable for them. That's a loan of last resort, in my opinion. Very dangerous. If your business is in jeopardy of becoming insolvent, that's probably not a loan you want to do, because you will be personally liable for it based on 100% penalty. So that's that's all I have to say about that.
Okay, so one of the other updates that came through the Flexibility Act was the payment deferral. So previously it was a 6-month deferral starting on the day of your loan funding. It has been greatly expanded now. It is, basically you need to submit your loan forgiveness application within 10 months after the end of your covered period. So 8 weeks or 24 weeks, whichever you choose. And then no payment will be due before the date on which the SBA remits the loan forgiveness amount. So that's quite a bit of time. But if you do not submit your loan forgiveness application within that 10-month period, then your loan is, payments will be due basically immediately. So that's definitely something to be aware of.
As long as we're talking about timing, just very quickly, the rules are that the bank has 60 days to act on your application, meaning it has 60 days to submit its recommendation to SBA. And then SBA has 90 days to act on it. And so you got 10 months plus 5 months, typically, if this thing drags out, and it probably will because of the volume. You're going to have a long time before you have to start making payments.
Okay, so as a result of some of these changes, one of the new changes as well is there's a new EZ form. So we still have the original fairly long form 3508, which was the full, and we'll go over that as well. Not too much has changed from that original form, but now there's an EZ form for certain eligible users, and we'll go over that. If you are a self-employed person with no employees and didn't use any employees in the calculation of your loan amount, then you could use this EZ form. Other employers may be able to use this form if you meet these criteria. So there's basically 3 boxes, or two other options, I guess, for the employers. If you did not reduce any compensation for any of your sub $100,000 employees by more than 25% during the entire covered period. And as a reminder, that test is based on 2019 compensation for each of your employees. And you have to look at every single pay period and determine if that amount annualized would have exceeded 100,000. So it's not based on their W-2 amounts or total comp for the year. It's based on a weekly test. So as an example here in the bottom, if you're a weekly payer and you have any employees that received a weekly compensation of $1,923 or more at any time during the year, then they're not subject to this compensation reduction test. Okay, so if you haven't reduced, if you don't have any reduction issues, payroll or compensation reduction issues, and if you can meet one of these FTE rules as well. So if you didn't reduce any FTEs, meaning head counts or hours or anything like that, everyone's hours remain the same from January 1st, 2020 through the end of your covered period. And that's covered period. So that's your 24-week period. If you're using 24 weeks, then you could use this EZ form. Or if you meet this criteria regarding reduced operations because of these COVID-19 restrictions that we've talked about from those listed federal agencies. So if your operations are reduced and you cannot resume normal operations because of these government restrictions, then you could also use this EZ form. Everyone else, so if you have any reductions in your FTEs, you're operating normal, but maybe you have some reductions for any reason, then you're gonna have to still use the full form. So a few updates came through on that form. It's very similar though, but the instructions kind of help clarify. So, okay, actually, and so as Paul mentioned before, there was a new final interim rule that was released last night, and it actually clarified this. I'm going to correct these slides after this presentation, and we'll send you out corrected slides. So this first line is actually not correct. So you have other payroll costs are either going to be paid during the covered period or incurred and paid within the normal operating, normal payment cycle after. So if you have something that was paid, after your covered period, that's fine. There was a lot of clarification on owner compensation and benefits, and I have a slide that will go over that. There were updates to the FTE safe harbors, and we'll go over that as well. And then this per employee compensation cap was increased. So now that we have a 24-week period, potentially, you have a greater cap amount per employee. So it's $46,154 if you use the 24-week period. If you don't, if you choose to continue to use the 8-week period, then you still have to use the cap of $15,385. So that's an important distinction to keep in mind when deciding if you should elect into the 8-week period.
So the one thing I'll mention at this point, and this guidance just came out last night, we haven't fully digested it. It appeared when the new applications came out that it was either 8 weeks or 24 weeks. And that actually is the case, but the rules, the new interim final rule allows for a borrower to submit their application for forgiveness before the 24 weeks is up. So let's say you finished off everything in 12 weeks. You could put in your application for forgiveness after that 12-week period. However, and I'm not sure how they mean this, you have to account for reductions all the way through the 24 weeks. So how you could do it early is kind of beyond me, but that's what the rule says. So just point that out. And I'm not sure exactly how you would calculate this cap, but that was part of the interim final rule that was issued last night.
All right, so owner compensation has been a big thing that we've been slowly getting clarification on. Now, if you're using the 24-week period, owner compensation is not going to be that previous amount, the $46,000. Owner comp is going to be capped at 2.5-month equivalent of their 2019 compensation or $100,000. So that's that $20,833 you see there is the 2.5 months of $100,000, whichever amount is lower. If you're using the 8-week period, you're still then capped at that $15,385 amount we saw, or an 8-week equivalent of your 2019 compensation. And this is true for S Corp owners, for general partners, self-employed, C Corp owners. It's all the same. And one thing to note here is that you'll have to have your 2019 tax return done, because that's where they're getting this information from, especially for the self-employed and the general partners where you don't have a W-2 to support. You're gonna have to have your 2019 tax return done before you can submit your application, because that's the support. For health insurance benefits of self-employed individuals, general partners, or S Corp owners, you cannot include their health insurance in the health insurance line because that's separate. That's included in their overall compensation. So it's already in their comp number. So it's explicitly written that you don't include, you have to pull those out of those health insurance benefits that the company pays for. For retirement benefits that the company pays for, you have to exclude amounts paid for self-employed individuals or general partners, but it appears that amounts paid for S Corp owners and C Corp owners are fine. And then the other thing I wanted to note on this is that the cap on owners is across all businesses, and that was something that was clarified or explicitly addressed in the new rules from last night. If you have more than one business, you can't use this maximum $20,000, for example, on each business. It is in total per owner. So keep that in mind if you have more than one business. All right, so the FTE exceptions, These were in existence before, but I wanted to go over them again. This was some clarification that came out a few weeks ago, I guess. So if you make a good faith offer to an employee, a previous employee who declines it, and you're unable to hire a similarly qualified employee, we kind of mentioned that before, that FTE exception, you don't have to count that as a reduction in your FTEs. Same goes for if you offer to restore normal hours and wages as before to an employee. Basically, the employee is making the choice to reduce the hours, then you don't have to count that as a reduction. And if you fire any employees for cause, or if you have employees that voluntarily resign or reduce their hours during the covered period, that as well will not impact. You get to add that back into your FTE test. Documentation for all of these is critical. Again, we're going to keep saying this. You don't have to submit everything in with your application, but you are required to have it. And so if, last thing you want to do is be scrambling 3 years later, 4 years later to kind of get this documentation in place when now you're being questioned by the SBA. It's best to do it now while it's fresh and while it's happening, especially for some of these where you might want to have an employee sign an offer that was declined or, submit their resignation letter, things like that. You want to have that documented now.
Just a quick comment. We serve mostly small business clients, and one of the areas that is very poorly covered by most small businesses is their employee files. And I totally understand that, but now there's dollars riding on this, so it's really important. It's a good time to get in the habit of documenting everything in a personnel file.
There are a couple FTE reduction safe harbors. So if you are unable to operate between the time of February 15th through the end of your covered period at the same levels of your business activity before the 215 period, due to those compliance issues that we were talking about before, then that's a safe harbor. If you reduced the second one was an existing safe harbor, so that first one was new. The second one is if you reduced your FTE count between the period of 215 and 4/26 of 2020, and you restored those FTEs to what they were at 215 no later than the end of this year, and that used to be 6/30, and now that's been pushed out to 12/31, then you also meet a safe harbor. If you don't meet any of these safe harbors, then you have to do those look back periods and pull additional data and run some tests to see if there's an FTE reduction. All right, so we still have a few unresolved issues. Probably the biggest one in my mind is this whole conversation around costs being incurred and or paid. They are still incredibly inconsistent in all of the published materials, including the application itself, and it's really not clear. AICPA has been pushing on Congress for weeks now to get this clarified, and it's just not happening. Our opinion is if you're going to use the 24-week period and you really don't see a problem now with using that 24-week period of fully utilizing your funds, why be aggressive with those first payrolls and those first expenses? Because the banks are still waiting for clarification. We're still waiting for clarification. There's just no reason to make it an issue if you're going to have no problem using those funds. There's definitely a clear exception with regards to the last payroll or expenses that occur at the end of your covered period. They give very clear examples in their materials that as long as those are incurred during the covered period, and you have to count days when you've got a cutoff thing there at the end, and are paid within the normal, AP cycle, normal paying cycle after, then that counts. But otherwise, it appears everything needs to be paid within the covered period. With our clients, we had a lot of examples where our clients received the funds early May 5th, May 6th, even May 1st. And as common practice with many companies, they prepay their rent maybe on April 30th, right? So it's a automatic, payment out of their account. That was paid before the covered period started, even though the rent incurred mostly during the covered period. You know, if you have a reason to be aggressive with that and pull that in, you may have an argument, but you may have to really fight that argument. If there's no reason, like if you've got more than enough now to really cover you through this whole 24-week period, I think our recommendation is going to be just skip it, leave it out, and, you know, move forward with the future rents. Now you've got 5 more months still to pay for rent. So certainly a conversation to have and something to consider while you're going through and compiling your data. You know, I would say make this as easy as you can for your bankers, and don't give them a reason to question something if you don't have to.
Good advice.
The second one you can see here, as of last night, we were kind of thinking, okay, you have to submit your loan after the 8-week period or the 24-week, and there's no ifs, ands, or buts. But we got that update late last night. We're reading it this morning. You can submit your loan application before the 24-week period if you've used all your funds. But Paul already mentioned this earlier. This compensation reduction issue is explicitly mentioned. Well, if you're not done going through that period, how are you going to know if there was a reduction? And so, you know, obviously guidance is needed on that, but it appears you should be able to submit that application before the 24 weeks is up. And we still don't have any kind of guidance or explanation on what transportation is. You know, that was one of the listed items that qualifies under the utilities expenses, and we just don't know. So we're definitely talking to our clients on a case-by-case basis. It's probably one of those things you put in at the end if you're trying to get into, you know, get to 100%. It's probably not something you lead with. You know, I would probably err on just trying to make most of it payroll, because that was the point of this in the first place. But if you're pulling in those other expenses, maybe prioritize the easier ones to substantiate versus something like transportation, which might be a little vague.
There's an issue that was somewhat resolved, and we discussed this in one of the articles that's posted on our website. The question about, you know, what can you legally use these funds for? And all of the data that came out in the beginning suggested that if you used it for other than payroll and other covered costs, leases, mortgages, utilities, then it wasn't legal. But the language has been conformed to the original act, and it states that anything that could be a 7A loan item. Well, 7A is pretty broad. It's basically a statute that's designed to expand a business, and it includes all kinds of things like acquiring property, building buildings, buying equipment, that sort of thing. Now, that's not going to be forgiven if you spend it that way. But originally, when this came out, we thought that they might go after you for fraud. But I don't see how they could possibly go through a fraud assertion when their instructions indicate that anything that could be used under Section 7A, these loan proceeds can be used for. So I think that expands the program a little bit, but it's sort of a backdoor expansion, because in the application, you stated that you were going to use it for payroll and operating expenses. And see, those were originally not allowed under 7A. That's why the PPP loan was added to the Small Business Act in the first place. So just for your good to know file.
Some previously clarified issues, bonuses and hazard pay are certainly qualified compensation, and we do not have concerns around that anymore. FTEs are calculated using a 40-hour work week, or they provide an alternative for a 1.0 FTE for anyone that works 40 hours a week or more, or and then a 0.5 FTE for anyone that works less than 40 hours a week. So that might be a good option for people who have a lot of employees, and especially if it's a substantial employee workforce that's part-time. And then salary reduction test is on a per employee basis. It's not in the aggregate. We already talked about the fact that you have to look at each payroll in 2019 to determine if they meet this criteria, this qualifying test for the reduction. And then you would compare your Q1 earnings with the earnings in the 8-week, or I should add to this, the 24-week period, whichever you're using, and you annualize those when comparing them. If it's, and that's for salaried. If it's, sorry, I don't know what happened there. For the employee reduction, if they're hourly, it has no regards to total hours. It's basically just their hourly rate. Do those lines show up on my screen? I don't know what those are. Oops. Okay, sorry if you see that. I don't know what that is. Documentation requirements. So regardless of which form you use, the documentation is the same. You have to have proof of your FTE tests and your compensation tests. So even if you're using the easy form because you said that you didn't have a reduction in compensation or FTEs, you still have to have documentation that proves it. You have to have support for all your payroll costs, other costs, everything you need to have support for. And there's a whole page on each application that details the kind of documentation that's required. If you're utilizing any of the safe harbors, make sure you have that documented. There's a 6-year retention requirement on these, and any loan that is under $2 million is not automatically exempt from an SBA examination. There's a safe harbor that was kind of provided for that, but they do still give themselves room to question you if needed. And then tax planning, we did bring this up in our previous presentation that we did, but for those of you that weren't with us, I thought I'd go through this real quickly again, because it's really important that everyone be aware of the impact this has on taxes. The income, the loan forgiveness amount is not income, but IRS has come out and said, yes, but according to the Internal Revenue codes, the expenses paid for with that non-taxable income is also not deductible. So they net to zero, and basically you're just pulling all those expenses out of your budget or out of your operating expenses, and now you're more or less still left with that income, if you think about it. And I gave this example here. If a contractor received a $200,000 in loan forgiveness, $150,000 of that was for direct labor, and $50,000 was used for other operating labor and expenses. If they had they've used that $150,000 for direct labor and billed $350,000, for example, as revenue. Originally, they would have had a gross profit of $200,000 less some operating expenses, and they would have had taxable income of $100,000. Well, if you take out basically that $200,000 of expenses now that you can't deduct, you actually have $300,000 of taxable income. This example obviously is an example of where they have revenue producing labor. If you've got significantly reduced operations and maybe not a lot of revenue, but your expenses are high and you were incurring a loss even with the loan forgiveness, your loss just may be less than what you were planning for. So it's just something to really be aware of. Tax planning will still be incredibly important this year, especially if you receive this loan. It will, it's basically the accounting for it, and this has come up a lot too, and I probably should have put a slide in here, but basically when you receive the loan, you recorded it on your balance sheet as long-term debt. Once you get the forgiveness amount from your bank, if it's 100% or whatever the amount is, you basically are going to debit the loan off your balance sheet, and you're going to credit other income. And our recommendation is to put that to other income, not to go and offset expenses, and don't bury it in income or anything like that. You really want to preserve your accounting data for comparability purposes and integrity. Leave everything as is without regard to this loan forgiveness. But once we know what that amount is, go ahead and maybe put that in other income. Let's pull it out separately so that we can see it very clearly. And that will really help your tax return preparer in making sure that they properly address this within the tax return and for tax planning purposes.
Just a couple of comments here. Number one, a lot of our clients that were early appliers and got in, found out after they got the loan that the expenses paid with the loan proceeds were not going to be deductible. And it was, they were very upset, obviously. The bottom line on this is, and Jessica mentioned this, if basically your operations weren't interrupted and your income didn't drop much, then you had a windfall and you're going to end up paying tax on it. If your operations were seriously impacted, then you got a windfall, but your other profit went down, and you're probably not going to end up paying much tax on it. The other thing to be aware of is the penalty calculations for estimated taxes are based on 4 dates. It's March 31st, May 31st, August 31st, and December 31st. And that normally doesn't mean much, but with this, it's going to mean a lot, because chances are pretty good that 98% of these loan forgiven amounts are not going to be forgiven before August 31st. So that means that taxable windfall, if that in fact is what happened, occurred after August 31st. By using the annualization method of computing the amount of estimated tax payments that were required, you can avoid a penalty. It's going to take a few extra hours on the part of your tax preparer to do it. None of us like to do it because it's tedious, but it can save you a penalty. So be aware of that.
All right, Eric. Well, that does it for us. So I will
switch it over. Perfect. Well, thank you, Jessica. Paul, that was great. I know we've got some questions in chat. Remember, is if you do those, put them out. And so now we'd kind of like to ask Chris to chime in from the perspective of a banker and give us his insight for how business owners can prepare for that inevitable meeting with their banker at the end of the process where they go for the forgiveness. So Chris, take us away and tell us that you'll be a nice banker.
Yeah, absolutely. First, I have to do that disclaimer that this is not financial advice, blah, blah, blah. So, you know, this is my being at the forefront of this and being in the banking industry. You know, while the forgiveness formula looks really simple, I mean, you get this and you spend this on X, Y, Z. The SBA and Treasury, as Paul and Jessica alluded to, continually change what is expected, defined, et cetera. The latest, I like the way they say interim final, because every few weeks it seems like there's another final. So the bankers are really trying to stay on top of this as well. And with that in mind, the banking industry, just like the accounting industry, have been pushing Congress to really define the roles of who does what, who forgives what, how do we determine it, who's liable if there's mistakes or fraud, et cetera. So with that reason, the banking industry as a whole, and my bank as well at Home Street, we're not currently accepting applications for forgiveness because the last thing that you want or the bank wants is us to make assumptions or take action that turns out to be incorrect. That won't help the business owner, won't help at tax time, definitely doesn't help the financial institution as a whole. So the guidance came out last night, so I'm sure we're digesting it. I know our process is in place for the forgiveness. It'll be pretty automated, which is a little different than the application process for most of the banking industry. So we're ready to go. We just want to make sure we do it right the first time. This is not something to take lightly or cavalier or jump ahead. One of the things I am excited about is the extension of the 24 weeks, because if you look at the previous, you got 2.5 times your monthly salary, but only 2 months to spend it. So either you're hiring more, spending more, or you have to use it on other items. And this 24 weeks, to me, if you can spread out your payroll over 24 weeks and you're only using it for payroll, I think it's a much easier and swifter process than adding everything else in. But that's on an individual. To me, that's just more of a observation than anything. We are recommending highly our clients meet with their CPA like Jessica and Paul, because documentation is key. It's not what you did, it's what you can prove, is how I like to look at it. And so having the documentation in place, whether it's the payroll company 941s, cancel checks for rent, you know, whatever it happens to be, have it saved on your hard drive, hard copies, whatever you need to do for that 6-year time period, and get it all uploaded. Because the SBA, just like every agency, has a due diligence and a fiduciary responsibility to make sure everything was done correctly. And so if we don't follow the right steps, or the clients don't follow the right steps, you know, the repercussions could be significant on the other end. So with that said, we're digesting the new rules, and trust me, as soon as we can get it up and running, we're going to be helping clients with the forgiveness piece. And Paul, I don't know if you've heard, I know that several Congress persons are very upset with that IRS interpretation and Treasury ruling, and they have vowed to do something about it, but I haven't heard anything about it in the last few weeks.
No.
And so I'm going to circumvent the chat question and ask if you've heard anything about it. So.
No, I think that the noise with the riots and the demonstrations has kind of drowned everything else out and taken everybody's attention away from it. I think it may come up again, but this is this regulation is old. You've basically never been able to deduct expenses paid with exempt income. And, you know, what came out was a reminder.
Mm-hmm.
You know, I mean, Congress said, oh, it's going to be tax-free. Well, remember when Congress passed this, they were passing this for businesses so they wouldn't go out of business, expecting that their business was going to tank. Well, you know, it's turned out that certain businesses flourished because of this. It's unbelievable. You know, a lot of vacations got canceled. Would you believe that plastic surgery's way up? Businesses that are doing landscaping, contracting, and pool remodeling, and spas, and all of that stuff, they're sold out. They can't keep up. You can't buy a bicycle. They're all sold out. They're made in they're made overseas, and you know, some of them are backed up to October. So there's certain industries that really benefited from this, and Congress wasn't thinking about when they said that. I don't think they were thinking about businesses that were going to have a windfall. They were protecting the people that were going to get creamed. And that's what they were thinking about when they said you're not going to have to pay tax on this. And it's true, you don't have to pay tax on it. You just can't deduct the expenses that you paid with it. So, you know, if this COVID-19 pandemic put your business in a big hole, you got 2.5 months of payroll given to you to kind of compensate for that. But if it turned out you didn't need it, they kind of want you to pay it back. And if you don't pay it back, then you're going to at least end up paying tax on it.
Paul, thank you for that question. Chris, thank you for that overview. I want to kick off. I'll use moderator or host prerogative on this, and I just want to underscore something that you had said on the first webinar that we had done with Polito on the PPP program. Jessica, I want to ask you: do you still think that the advice holds that the first thing that business owners should do is lay out a business plan for that 8 or 24-week period, creating a budget around it to really sort of think through how that period of time is going to play out, and look at creating essentially a new budget for that period of time so that they understand their new inflow of funds and their forgiveness on the back end?
Yeah, I do still think that's incredibly important because you don't want any surprises. And now you really want to be able to look at those other possible reductions as well. If you do have any compensation reductions or FTE reductions, you've got to look to see what that impact is, and if you're able to remedy those reductions by other means. And there is ways to do that legally. I think, one of our original recommendations was to set up a new bank account, and that's probably not as necessary, although it may have been helpful for some people. But it's definitely not required in the documentation. And then I did see a question kind of pop through as far as accounting for the expenses. You don't need to put them in separate new accounts. I think it's really much more important to keep the integrity of your accounting as is, because you still want to be able to use this year as a look back year for comparability purposes and budgeting and things like that. And so if all of a sudden you start putting these related expenses in a new, random expense account for the purposes of pulling apart, you've lost the the overall goal of your accounting data in the first place. So I would keep expenses as you normally would account for them in your system.
Perfect. Thank you. Excellent. Paul, anything to add on that?
No, just that this is an opportunity. Whenever something like this happens, it's a business opportunity. As we said in the previous webcast, put the business interests first. Yes, it's intended to keep jobs and all of that, but it's also intended to be a lifeline for your business, and you need to look at that and look at this opportunity in those terms. It's much more important to use the funds to keep your business alive and healthy than to get 100% forgiveness.
Great. Perfect. So one of the first questions we had in chat, I think this is just simply part of the form, if I remember my form that I'm remembering, for business owners that are making that choice between the 8-week and the 24-week, is that a choice that they're going to make on their form that they fill out for loan forgiveness? How do they make that choice in terms of taking that pathway?
Yes, I believe it's on the form itself. Maybe it's not on the form itself.
It's the covered period. So if you're making the choice by choosing your covered period.
Got it. Great. So you'll either choose one that's 24 weeks in length or 8 weeks in length.
Correct.
Start from there. Perfect. Thank you, Paul, on that one. Here's a question that was kind of, again, I think maybe think this through, is a question was asked, would it be beneficial to go back and use the funds for just payroll costs for the 24-week period, if that's possible, to reallocate funds from utilities paid to cover additional payroll costs during the 24 period? Would that ensure or make easiest the documentation for maximum forgiveness? In other words, I think they got an amount that was premised on the first idea, which was an 8-week period. That was kind of the amount that SBA and that they applied for and they got. Now they've got a longer period of time. Should they just sort of basically focus in and look at their payroll over that 24-week period? If they hit the number and the bogey, make it clean and just go with that?
I would do that. I
Yeah.
mean, it's certainly simpler.
And it reduces the documentation requirement, because if you're not submitting other expenses, then you're not worrying about pulling that documentation into it.
Great.
The only thing I would add, Eric, is that if there is employee either payroll or FTE reduction, that you're going to want to have proof of other expenses to try to make up some of the difference.
That's a great point, Chris. So, it's sort of like, if after 18 weeks, people are kind of done with it and tired, you see that FTE requirement go away, you don't backfill, or there's no reason to backfill those positions. You've got some additional expenses that you can look at that 40% nut so that you can make the number.
Not necessarily.
Paul?
Not necessarily, because the payroll is going to be based on the payroll after considering reductions to the forgiveness amount. It isn't, you can't just swap because those tests are those tests. You have to do those tests. And I don't think you can just assume that, okay, I fell short on payroll because I laid some people off. I'll just back bill it with rent. I don't think it's going to work that way.
No, because on the applications, you actually add up all your total expenses and then you go into the reductions.
Got it. Got it. Got it. So it'll, in other words, it'll be, you'll do the amounts that you're going to be looking at. Perfect.
Mm-hmm.
Okay, great. This was a question, I think you guys had answered this because I think it's on the FTE test. And Paul, you've mentioned this a few times, but the question is, if all the funds have been spent after 12 weeks, is there any reason not to just apply for forgiveness at that point, rather than waiting for the entire 24-week period of time? And I think you've covered that, because the question is, how do you know what's going to happen in the remaining 12 weeks with the FTE test? Is that correct, Paul?
Exactly, and that just came out last night, and you know, I'm just going to cry uncle and say I need a little more time to study it. But the bottom line is, if you're at 12 weeks, you've elected the 24-week period. For that 24-week period, you have to account for your FTE reductions. You have to make sure you've met all those tests. And if there's no way that those tests could possibly reduce your forgiveness, then I suppose you could turn it in early, and maybe that's what they were thinking. But if you lose some employees and you don't meet any exceptions, I think it's going to reduce the amount of covered payroll expense. Again, we just need some time to study this, because it's a big question. We were thinking that, okay, if you know, we use that $15,000 or that $46,000 figure for 8 weeks or 24 weeks. Well, if it falls at 16 weeks, then that would be another number. Well, can you imagine the banks trying to process these things with all these different maximums? It would be an administrative nightmare. So that's why they said you got to account for the 24 weeks, even if you apply early. Well, how can you apply early if the 24 weeks aren't up? It's very unclear what they mean. And we just need to study it and run some examples through our templates that we've developed for this, so that we can see how that might work. But at the moment, you know, we were surprised to see that this morning, and we need to kind of figure out how that could work.
Perfect. I think you've covered this question, but just to underscore it, or just nod and say yes, is that a question in chat would you recommend isolating the expenses paid with the PPP funds on a business's P&L, since it won't be deductible? And Jessica, I think you've said, you know, a couple of times, that's probably useful for right now for your compliance or for the loan forgiveness, but it really has detrimental issues for having the accounting to make for business choices down the road, or smart business choices down the road. So
I think I would add, if they want to, like if they're using QuickBooks, for example, and maybe using a separate class for the use of the PPP funds, if it doesn't mess up other data. Again, you know, keeping in mind, if you've got direct labor and you need that direct labor in with another bucket, you got to leave it there, right? You need it there for your operations. So
okay, great.
It's really unnecessary, because the loan application isn't asking you to account for where the money came from that you paid the expenses. It's asking you for the expenses paid.
Yeah.
You paid your labor, you paid your utilities, you paid your leases. It doesn't matter. You know, you're going to report what you paid, and you know the maximum amount you're going to get is what you borrowed. And to the extent that you didn't spend it all, then you're going to have to pay it back. So it's really unnecessary to account for it in that way. It's basically, in my opinion, a complete waste of time and effort.
Great. And let's see. Thank you for does that mean that 70% reduced to 60%? And then one question that was asked is, yes, the slides are going to be available. We're going to send them out to everybody who was registered on this call. They'll be on the SDNEDC website, so they will be up and ready and good. I'm going to ask this last question. I think we've got a couple times around it, so I'm going to ask it one more time just to make sure that it's clear. This comes in from Francesca over on chat. So again, 24-week period, they got the loan amount. They're good with the payroll numbers that they're looking at for that expenses. They meet the FTE requirement, and they hit that bogey for the amount of covered payroll. We're all fine with that. They don't need, do they need to, I guess, worry? That's a fancy accounting term, so I know it's technically means something. But what should they think about, or how should they approach the other expenses that are allowed under the PPP, but they've already taken care of the bogey with the payroll costs that they've incurred for that 24-week period?
I mean, I think they could just kind of put them aside. And once you start working on the application itself, and if you find, I'm a little short, I wasn't expecting that, then you quickly pull them in. But it might be easier to just lead with payroll and then, like you said, kind of backfill with the other expenses if you need it.
And I think, Jessica, this gets to the point that you guys have made both this and prior. That's why putting together a business plan and a budget makes so much sense, rather than trying to do it after the fact. Is think about it right now. Look at your business for the next 6 months. Really think, a hard-headed assessment of what you're going to have coming in, what you're going to have coming out. Take that PPP loan and then really create that six-month business plan.
And we've been working, so we designed a template with our clients where they're actually able to enter in all their data as they're going through the covered period, and it's forecasting the entire application. So it's helping our clients to really make those decisions with regards to this. Do I need these expenses? Do I not? How is my application looking at this point? And I think that's just been an amazing tool for those clients.
So I one last question, and then we'll finish up at noon because we promised you that. So so maybe we've gotten guidance here. A couple of people got their PPP loan right around May 8th, first part of May that they've got that. And then on that same day, they had payroll expenses pulled for a prior payroll period that ended sort of the last part of April to May 1st. What should they do? Is that going to count against it, for it? How should they be thinking about that payroll expense?
So our opinion at this point would be, unless you really need it for some reason, you're not able to hit the whole 100% with future payroll costs, we wouldn't pull it in, because it wasn't incurred during the covered period. That's that whole incurred and paid conversation that we're still not really happy with how they've responded to it. Why push it? Why give your bank a reason to reject it because of the ambiguity around it? Same with like rents, like if a rent was paid April 30th, but you didn't get your loan until May 1st even, it didn't get paid in the period. Even though it was incurred in May, it didn't get paid within your covered period, it may not be eligible. So unless there's a really good argument to pull it in, we would recommend not and just start with the future payments.
Perfect. Well, again, thank you both. I'm now going to make a plug because it's important. So I know we've still gotten some additional questions in chat that kind of get into some pretty significant details that really require sort of some one-on-one conversations with the business owner and the CPA. I know, and I'll let you guys either give the 30-second spin or I will, that Polito has stood up a separate practice which allows business owners to engage you at a varying levels of engagement to really talk through this specific thing. You're not signing up for the whole Polito experience, so that doesn't mean your taxes or anything else and everything. But it's a way of business owners approaching this specific issue at, again, a variety of kind of levels of engagement. So did I summarize it right, Paul and Jessica?
Yes, thank you.
Sure, perfect. And so I would encourage business owners. I know that, you know, everybody's, you know, we're all in kind of, you know, recovery and survival mode. Polito's made this reasonably affordable and trying just to cover expenses. So it would be a way for you to really leverage that talent to get in at that specific thing. Paul, Jessica, I want to thank you so much. You guys have been great investors, great neighbors. You're our CPA, so we love you for the work that you do for the council. Chris, as always, thank you for your insights as our treasurer and our service to the community in making a more competitive North County. I'm going to encourage anybody that's on chat. You've got our emails that we've got. You've got my emails. If there are other programs that you want to see us stand up, which can help your business recover and ask, you know, kind of these more technical questions, technical topics of economic recovery, zap me emails with ideas. We'll line up some expert speakers, and we are happy to do more webinars as the summer goes on. Thanks everybody for attending, and have a great rest of your Tuesday.
Thank you.
Thank you.